If you are a property investor, I'm sure you've noticed that finding the right deal is the hardest thing to do. Hence, if you're a property investor, I advise you to basically find out how can you become a part of what we are doing so that you can basically invest in the right property. Invest like a pro with no wealth.
And so looking at that point whereby we're talking to investors and also first-time buyers and beginners, now I'm hearing inflation, I'm hearing the interest rates going up. So the question is, looking at the 20 years, because I know some people are panicking right now. Some people like, I should be going out or I should be stopping. Now with the 20 years that you've been in the market, we had a conversation about if we can talk about what was the worst case scenario and what's happening right now. How would you define what's happening in the current market?
So guys, I think that the level of discomfort in terms of, and we mentioned it, 4.25% in terms of the repo rate going up and obviously affecting the interest rates seems harsher because we've come out of a deep V. We started off kind of December. Do you guys remember 2019? We were all celebrating New Year's. It's going to be such a lekker 2020. And then by March, we were in hard lockdown. So we went down because people weren't spending money to mitigate inflation. We went the lowest we'd seen in 53 years. Everyone was talking about it. We were at 7%. That was amazing. So what we've done is we've come from that deep V. We're going up. And we're actually normalizing. It just feels like it's really hurting because we've come from a low base in a short amount of time. So December 2019, the interest rate was about 10.5. So yes, we're 75 bips up, but we're trying to, the SARB does it, the Monetary Policy Committee sits and decides how can we mitigate inflation. Food costs are high, everything else is high. Let us try and rein in irresponsible spending. Having said that, a home loan is not an irresponsible spend. It's linked to an asset. Yes, it's credit, and yes, it's going to affect our monthly repayment, but it doesn't change the core value of home ownership.
Okay. All right. So
you wanted to give me an example. So I think what you're asking for is a bit of perspective.
Yeah.
I bought in 2007 my first house, I think at about 12%. And by month 4, it was at 16. So that was kind of the highest we've been in recent years. Everyone looks so young and fresh. Back in 1996, the interest rates were 25.5%. So our parents have gone through it. People will have frame of references when interest rates were so bad. And let me tell you guys, people were still buying and selling property.
True. That's something that I really appreciate about such platforms whereby I'm not speaking from fear. We're putting this issue on the table and we're looking at it from all angles. And it's very important for us to look at it so that we really have perspective about such.
So my favorite stat ever, and if you guys want to write this down, 46% of applications that are declined by one bank, so 46%, are approved by another. So what does that tell us? If we shop around and multi-submit that application, we double our chances of approval. Why? Maybe your own bank knows you too well. Maybe another bank has got an appetite for your particular deal structure. But by multi-submitting, not only are you doubling your chances of approval, you're also in a position to negotiate because you've got comparative offers. Your banker works for the bank. Uber Home Loans works for you.
So somebody who does not have any active debts cannot have a credit profile because you don't have debts that they're going to use to check how are you paying them. So what happens is that when you go to the bank and say, okay, I'm looking for a loan, they're going to say, all right, we don't know you. We don't know how you pay. So what do they do? They go to the credit bureau. They say, okay, we want to know how does Kay handle her debts? Then they check and say, okay, K has missed one payment, or K is paying well. So they are going to use that to determine if they're going to give you credit or not. So that is your credit profile. So there are a lot of things that we're going to talk about, the categories that they're going to put you under depending on, on your behavior, on your repayment of these debts. Ne? And in South Africa, we have 52 credit bureaus, just that, again, the famous one or the ones that the bank used the most is TransUnion and Experian. You asked a question earlier on to say ClearScore. ClearScore, it's not a credit bureau. ClearScore, it's an app just like Facebook, an app just like TikTok, an app just like any other thing. So what they have done is that, guys, a credit profile, a credit report, if it's the first time seeing it, it's not a very good thing. It's just a long report where you don't even know what is what. So ClearScore is like, oh, so we see that people don't like reading credit reports. Then what do? They built an app. So in that app, they break down your credit report nicely for you with graphics, explanation, and everything. They get the data from Experian. So ClearScore, when your bank is giving you loan, they don't go to ClearScore, they go to Experian. So ClearScore is not a credit bureau. So yeah, that was a good question, because a lot of people, because we normally use ClearScore in South Africa because of how it's designed, we always think that it's a credit bureau, but it's not. So with credit score, this is how what happens. You get your credit. When you get your credit, you need to pay your credit. So guys, the contract you sign with your financial provider, it's a legally binding contract. That's why every time when you're not paying that, they have the right to take you to the debt collectors. They have the right to take you to judgment, which I'm going to explain what is it. So whatever minimum you say, okay, I'm getting this loan from you, and then we are both in agreement to say, I'm going to pay 500 every month. You need to pay that 500 rand without fail. The time that you don't pay that 500 rand, whose duty is it to let the bank know? It's your duty. You don't have to wait for the bank to call you and say, you missed your payment, and now you start dodging those numbers thinking, in Sotho, can I put it, like, we have a liar, not realizing that you are actually sabotaging yourself in terms of your credit profile. So you miss it one day. You miss it 2 days. It's your responsibility as a client to say, okay, I missed my payment, which I signed for. Let me go and transfer the money. Let me call and make an arrangement. Don't wait for your credit provider, because most of the times, they'll call you 2 times. The third time, they're taking you to a debt collector. And once your credit is under a debt collector, you are damaging your credit profile. Now the home loan that you want, you might end up not getting it. Okay. Okay, so I am a personal finance coach and a personal finance advisor. So what I help clients with, I help clients with risk planning. Remember, when you're getting those home loans, they're not your homes right now until you finish paying them. They're not your properties right now. So what do I help you with? I help you with protecting that in the event that you pass on, and then your kids that property must not be taken away from your beneficiaries. It can still be producing money because it's now gonna be yours in terms of your home bond cover, your life covers, and all the risk planning, that your disabilities and the likes, your retrenchment covers and the likes. And the second thing that I do, I help you with your investment planning, but only cash investment, not property investment. Though that cash investment, they're also going to allocate it into their property investment, not like this property investment where you go and buy the property itself. And again, I coach people into paying off their debts. It's not debt review. So before you can even think of going to debt review, because a lot of people think they do not have money. So what do? I sit down, analyze your statement, analyze your expenses, see where we can start paying those extras, see where we can start negotiating with the bank to say, you know what, right now I cannot pay the full amount. Can you please can I still pay this amount for the next 6 months while we structure everything to minimize people to going to under debt review? Because guys, to get out from that process, maybe you can attest, it's not easy to get out of that process. And I also help clients with budgeting. A lot of people do not budget, so they don't understand where I get paid tomorrow, the money is gone. What's really happening? So I do budget coaching as well. So that's what I do for clients.
We say that you shouldn't be emotional. I mean, we'd have a conversation with someone and say that don't be emotional when you buy. But what do they mean when they say that you shouldn't be emotional? So some of you think that I'm not emotional, however, you are emotional. So that's what we'll be debunking with this slide over here.
Okay, so we have investors should be driven by their business model and not their emotions. So we have three biases that a lot of people are actually buying properties based on, right? The first one would be location. We've all heard someone saying that, oh, this location is actually good right now, you should actually invest in it, right? So those are the 3 or 4 things that a lot of people really say that this is why you should invest in this. So it's firstly the CBD, they're saying upcoming suburb, they're saying a new development, or they're saying a township. Something that I really need you to understand is that we could be purchasing the same property, right? Next door each other. Neo and I purchased the same property next door each other. However, I'm happy with my investment. Neo's not happy with his investment. I'm running cash flow positive. Neo's not running cash flow positive. So now that shows that location isn't really the number one thing that we should be looking at, that if I get it in the right location, I'm sorted. The price of that property is the one that we really need to understand. Because now if I'm purchasing the property at 500,000, I was able to negotiate to 500,000. Neo purchased at market value at 800,000. Neo would be paying around 8,500 on a monthly basis. I'm paying 5,500. Yet we're still in the same area. I'm happy with my investment. Neo's not happy with his investment.
Yeah. And let's also look at the new development one. The new development one gets people so bad, and it hits me when they come to us and reach out to us and say, "Gents, I bought this property. However, now the person said that this new development is upcoming. It's good. But now we need to understand something. What phase did I buy it at? Because you find out that there's 5 phases to it. And let's say the people in phase 1, they bought it at, let's say, 300,000. People in phase 1 bought it at 300,000. So let's say phase 1. And now, by the time you are buying it, let's say you're buying it at phase 5, the properties are already going at, let's say, 890. Look at the growth that has happened in this area. It's a no-brainer that there's been so much growth from 300 to 890. So what will you then do? You'd buy. Only to find out that there's a possibility that it has hit its ceiling when it comes to increasing so much. So we really need to understand that the difference between when I'm buying distressed properties, what is the strategy behind distressed properties? When I'm buying land, what is the strategy that comes with buying land? When I'm buying into new development, at what phase am I buying and why? So I won't be just investing in new development because it's the new place in town. At what phase did I buy? And again, ask yourself, if I'm saying that I want return on investment, which is cash flow positive, even if it's in a new development, but it doesn't make financial sense, I don't want to see this.